Hey, welcome back, everybody, to today's Market Explained 4-Star Podcast. I'm Brian Castle, your host. I'm here with my co-host, Chris Reardon. Chris, welcome to the podcast.
Thanks, Brian. Glad to be here. Glad to talk a little bit about the markets.
Well, and we're going to give you an update today, folks, about what's going on in the financial markets, the economy, and then what we see out there. Of course, Chris is the master of all things portfolio. He's our director of development at 4-Star. And for those of you who are not aware, he's also a Cleveland Indian fan, and he's got a big brood of 3 young kids under 3 years old. So congratulations, Chris. Welcome to the podcast.
Thank you, Brian. Glad to be here.
Brian Castle, I'm the founder and CEO of 4-Star Wealth. I'm an Eagle Scout, trustee of the National Boy Scout Foundation. I'm advisor to CEOs and insiders of companies. I'm chief dad to Quinn and Evan and husband to the amazing Tripty. So just our bios, that's where we are. If you like what you're hearing today and you enjoy this program, please tell your friends about it and give us a 5 for 5 ranking. We'd appreciate that. So today we start out with markets and again, the economy, and then a bunch of little things about what we see in the world out there. Chris, where are we on the financial markets, all the different relationships between domestic equities, international equities, commodities, cash currencies, fixed income? Where do we stand on those?
Yeah, Brian. So we still have domestic equities as the number one position. We did see a little bit of a pullback, though, for the first time. It pulled back to 313. That's minus 7 points. So it's kind of pulled back from the 320s. Now it's kind of the low to mid teens. And then number one, but still by far the number one position, holding that pretty steadily. The number two position is international equities, and it's lost 4 points, I should say, from the last podcast we talked about, and it's at 255. So still hanging relatively steady in that number two position. But the big mover was commodities. So commodities moved up 24 points from the last podcast, and it's at 244 tally points. So it's starting to challenge for that number two position. But interestingly, we saw a run up in commodities, and then it kind of stalled out. I think the closest it got, it was within 1 point of international equities. And then, as you can tell from the point differential there, it did kind of fall back a little bit after that. So it's still holding steadily, and it's still very close to that number two position now, much closer than it was. But it did kind of stall out a little bit. So we'll see if we get another resurgence there again and see if it can overtake that number two position. In the fourth position, we still have cash. And this has been really steadily even flat, if not moving downwards. It lost 4 points since the last podcast, and it's at 127. So really just a kind of flat to downward movement there. And likewise with currencies in fifth, and actually I'll just mention now fixed income in sixth. So currencies is in fifth. It was -5 from the last podcast at 80, and fixed income still in last, -5 as well at 69 tally points. So I would say the big story would be commodities and kind of the resurgence we saw there, not only in industrial metals but oil and precious metals as well.
Okay, well, great. So we're still seeing the main stock market act pretty well, but it's pulled back a little bit. We saw kind of a sloppy month in April, and that's kind of continued here into May, isn't it? A little bit.
Yeah. I mean, earnings have been, I would say, mixed. We definitely have some. It's been a little bit less consistent than Q1 earnings wise, but there's definitely been some beats to the upside, I would say. So I think that's held things in there a little bit. We've seen some pullback, some large earnings misses, but on the whole, I think things have been more stable than maybe people were anticipating. We haven't seen a very, very large pullback really yet.
So Chris, we're decidedly in a bull market. We've seen the market hit new highs in recent months and then pull back recently. But then when commodities are running, commodities are a cost to business. So we can make money in commodities, but if commodities are running hard and fast and the prices are going up, that's a problem for business because commodities are a cost. So hopefully that doesn't continue forever, and then the equity markets still recover. But we talk, Chris, in terms of these market dynamics where we'll have a rally, but then there's pullbacks within the rally. So this feels more like a pullback than the beginning of a huge decline to me. By the way, it's acting. It seems like things are starting to act a little bit better in the last week or so. Don't you agree with that, or you think it's a pullback? Not a pullback.
No, I would agree. I mean, I think the one unknown variable out there right now is the Federal Reserve and what they will or will not do. I think right now the anticipation is that they will hold off to any rate moves till after the election. But if we see a sharp pullback, I mean, we've seen it before 2018, kind of Q4. Um, it would be interesting to see if the Fed would relinquish and start to lower rates, or at least posturing even that they were going to lower rates quicker. And that's what we saw in 2018 when we saw a huge bounce back in 2019. So the unknown variable is really how determined is the Fed to beat inflation, and how much are they willing to give up on the markets or economy. And that's what I think the market's trying to digest here. I don't think there's any doubt that we're slowing down, albeit I think it is a little bit more of a steady decline on that slowdown so far, at least. It could certainly accelerate. And I think the other thing that you mentioned, Brian, is inflation has certainly remained, I think, more persistent, even bordering on whether it's stagflation or even reignition of the inflation process. So we're still waiting on numbers, and obviously we can just kind of take what we've seen so far. But there's a lot of data that can digest, and like I said, I think that the wild card really is what the Federal Reserve would do.
Yeah, well, we'll see. So right now, it still feels like a pullback, but then if it
Mhm.
turns around and starts breaking the previous lows and everything, then we'll know that it's not a pullback. But if it holds and starts to slowly rise again, then then the pullback is always an opportunity, Chris. So we'll see. We'll see how it plays out. And some people will take positions on a pullback and then keep tight stops in case they're wrong, and let those positions go if they get stopped out. So another interesting thing that's happening is technology was so hot last year. And then since the fall, it's not been that hot. And this year, technology has not been strong. But if you look at the relative strength and all the internal metrics, the technology sector of communications is waning. And the relative strength has been going down. It's ranked now of the top 11 groups. Our friends at Canterbury that do analysis on relative strength on each group show that technology is 9th or 10th out of 11. So it's some of the weakest technology or the weakest relative strength out there. So then we've had like a 2-week rally in technology, but it hasn't changed the relative strength figures that much. So it's pretty easy for sometimes folks to get caught up in, oh my God, I better buy these things right now. And especially technology, because they move so quickly. Technology is just big moves up, big moves down. So you'll have a 2-week rally and everybody gets scared, like, oh my God, I got to buy these back. So be careful. If you do, maybe straddle, do a little bit of technology buying, but don't go full bore. Wait till you see it's a confirmed rally. This technology could turn right around and go right back down if the relative strength that we're seeing holds. It will go back down. So don't get too confused about a rally like that. And that's one thing we're seeing. And then also the dollars continue to be strong. We're wearing 34 trillion in debt, Chris. But as much as our economy has some issues and problems, we're still seen as the best place to put money. We're still seen as the strongest economy in the world. So the dollar's strong.
Yep. Yeah. I mean, I think, as much as we have all this debt, and then, like you said, Brian, I mean, there should be, I would say, a weight bearing down on the dollar, if you will. You look at the EU, and they're expected to cut rates soon. And then you look at, which we'll talk about a little bit later, Bank of Japan, and even China. I mean, China had record exports. They're trying to keep the yen lower. So really, even though the dollar, as you said, Brian, is pretty looks pretty bad from a debt perspective and a lot of different aspects. It's kind of the prettiest looking one at the ball right now, as far as currencies look.
Well, we'll see. Of course, if we end up having a debt crisis, then of course relative strength will fade. But we're still getting a lot of credibility as a country, and we're getting a lot of deference to the fact that we've done it so long, so good for so long. But that existential problem of 34 trillion in debt could come home to roost. So a good a good president might say, maybe we need to pay down some of that debt, or certainly not keep adding to it. So we don't, run head into a full blown debt crisis, which we could. We've seen it happen in countries all around the world. And is America immune from debt crisis? Absolutely not. If we have too much debt and our interest rates are higher and the cost of that debt is higher and higher, it's now estimated to be, with the 34 trillion in debt, more interest on the debt we have than our entire U.S. defense budget, which is $1 trillion. It's real big money. So we've got to get our debt down. We've got to get our interest payments down, and continue to grow our economy before that debt engulfs us. So,
yeah. And one interesting aspect I'll just kind of highlight real quick, and it's a kind of a side subject with it, but it's really interesting, and people have started talking about it. Is will the Federal Reserve lower interest rates because of that debt issue? Because as interest rates remain higher, people have seen it. I mean, the 10-year U.S. Treasury, the 5-year, I mean, they're 5%, 2% or 5%, yields. They're not 2% yields. They're not, so that debt is getting substantially more expensive for us to service. So the longer we remain in this higher interest rate environment, the quicker that number is going to go up. That interest rate is only going to snowball downhill so there has been speculation that the Fed's going to capitulate and lower, even if inflation's accelerating, just because if we don't, they're just kind of almost lighting a match on as far as our debt payments, because they're just going to continue to balloon more than they are.
So international markets, Chris, are interesting too. China's slowing down a little bit and exports are slowing. You have a little bit of comment, right?
Yeah, so China's official manufacturing purchasing managers index came out, and it came in at 50.4 in April. So that was expanding. Still, anything above 50 is an expansion, so it's good from that standpoint. But it was a decrease from the March reading, which was 50.8. So kind of mixed numbers there, still showing that slowdown, but still a little bit in expansion mode. And then Chinese exports were up 1.5% in Q1. In Q1 2024 compared to 2023. So a big part of that was the strong dollar and the weak yen over there. So when you have that, when you have that weak currency versus strong currency, it makes their goods cheaper for the US dollar to purchase. So we can purchase their goods at a much reduced rate. So usually you see exports increase. So that's a lot of what we're seeing with those exports. Some people are saying that the Chinese government's purposely keeping it down, and there has been speculation for decades now, or even the last 20 years, that the Chinese government was doing this. But we certainly saw that impact in Q1, and then we saw a close neighbor to China, obviously Taiwan. We saw their Q1 GDP came in at 6.51%, which beat expectations, which were 6%. And a huge increase from their Q4 2023 reading, which was 4.93%. So a big uptick for them was their increase in real exports of goods and services. That was up 10.2%. Obviously, Taiwan Semiconductor, which is, they're huge, producers of semiconductors there. So that was an interesting number to see. And then kind of keeping it in the Asia Pacific area, the Bank of Japan, and it was the last podcast we talked about the coming potential currency crisis going on there. So Bank of Japan came out and they held their rate steady at a range from 0 to 0.1%. They're still anticipating inflation to stay around 2%. But what happened after that is the Japanese yen deteriorated. It was at one point trading at 160 Japanese yen per dollar, which is the lowest it's been in over 34 years, going back to the 80s and 90s. So at some point, the Bank of Japan actually came out and went and purchased yen. So they kind of intervened in the market. And that was towards the end of April. And they bought about 7.56 trillion in yen, which is the equivalent to about $48.36 billion worth of Japanese yen. So when they do that, they sell the dollar, they buy the yen, and that kind of pushes the yen versus the dollar up a little bit. So it's settled now around 153 Japanese yen per dollar. So still probably elevated from what they would like, but it's going to be really interesting because if the Bank of Japan continues having to intervene there, we could really start to see an issue, and that could, as you said, Brian, that could start kind of the process of maybe a credit or a debt crisis. So something to keep an eye on. Right now it seems like they are intervening, but we'll see if that maintains.
Well, turning to our economy, the numbers were strong, and some markets are reacting positive to it. But the GDP number, however, came through weaker than expected. And so, we've been looking for this for quite a while, and so many other numbers are looking weaker and weaker, yet the GDP numbers held up. But now the GDP number for the first quarter is actually 1.6 versus an expectation of 2.4. So we're starting to see those numbers go off. Now we're not at recessionary levels. Recessionary would be negative GDP or 2 quarters in a row negative GDP. We had a mild recession in 2022, but we're not quite there. But it is slowing down, Chris.
Yeah, yeah. I mean, and that's the another interesting dynamic that we've talked about on here is even though it's a negative GDP number, the market sometimes when we get these negative economic numbers, the market actually pops off of them or goes up quickly because when we get these negative economic numbers, the expectations rise, at least the market betting wise, rise that the Federal Reserve is going to lower rates sooner rather than later. So kind of this really interesting dynamic where it's almost like we've talked about bad news is good news for the market, or at least in the short term. But we are seeing that slowdown certainly, which is interesting to see.
Well, and then we talked about the interest rate cuts that were supposed to happen. We started the year assuming there were going to be 6 interest rate cuts. Then there were only 3. Then it was March. Then it was June. Now it's in the fall. Maybe it's only 1 interest rate cut. There are certain investment advisors who are bond experts who are saying that we may not even have one this year, a rate cut. And in fact, some are saying the next rate move is upward because of inflation. The administration is in the middle of a difficult re-election campaign, and it's election season in America. November is obviously the general election for president. So the spending continues, and we fear that they're going to keep spending to keep favor with the public, but at the same time that could cause inflation to come back. And we're seeing 4 months in a row now of inflation numbers going in the wrong direction. It hasn't spiked up big time yet, but it's moving all steadily in the upward direction. So it's hard for the Fed to lower rates that would spike inflation even more and spending even more. So maybe some of those folks will be right. Maybe the next move in interest rates is up. We give it a lower probability, maybe 30% chance, but it's possible.
Yeah, I mean the PCE or personal consumption expenditures price index came in for Q1, and that came in at 3.7%, which was above expectations of a 3.4% increase. So we're seeing that reacceleration, where it's not even staying at that same level. It's starting to move upwards. Although what you said, Brian, not quickly, it's moving up steadily, but slowly and steadily. So it'll be interesting if that continues and we start moving into the 4% and even closer to the mid 4s. We've talked about it on here. The Fed's mandate really is 2%. And the further if we're double their mandate, it's really hard to make the case that they should lower rates. And like you said, Brian, that's where you really start getting into the scenario potentially where they have to raise rates again. If we see that at the current interest rate, at 5% or 5.25%, that inflation is starting to reaccelerate again, they have to increase it, because if they don't, it's going to start, spiraling again.
Absolutely. Well, we'll see. The economy is in kind of a very transitional period right now. And I guess we just need more evidence, Chris, to see where it's going to go. And let's just hope and pray that the strong economy in America can continue. And if not, that the Fed makes the moves they need to protect us from a big down decline. So now, Chris, and what we see out there's a lot of interesting things going on in the market. You had some comments about Apple.
Yeah, so I'd say two tech points to make with earnings. With the recent earnings, Apple came out and announced they were going to do a record $100 billion stock buyback. So that's the largest ever, and that's obviously very, extremely large. So that had a huge impact on the stock. I believe it was up almost 10% on their earnings day. So big news there. And then Google came out and announced their first dividend of 20 cents per share. So we continue to see a lot of these tech stocks, which is really interesting. They're getting more conservative. They're almost behaving less and less like tech stocks and having those dividends and performance numbers that you'd see from more blue chip cash cow style companies. So really interesting. And then kind of playing into some of the inflation that we were talking about, food prices. With the higher food prices, households are now turning to discount grocery stores. So Aldi, which is, a major discount grocery store, in March this year had a 26% increase in foot traffic compared to the year prior. And in comparison, Kroger saw only a 6% uptick during that period. So a major increase, over 20% of the competition, above what the competition had, and foot traffic increasing. And then comparison-wise, a basket of goods at Aldi are about 6% cheaper than Walmart, which is obviously the kind of staple when you think about kind of cheap goods there. So really interesting. I mean, we're seeing the consumer change drastically. Some of the spending, actually some of the recent earnings, Starbucks and McDonald's. Starbucks saw a huge drop off in traffic and earnings there. So we're seeing the consumer start to react to these higher prices and pull back on that spending and either look for cheaper options or things like that. So, I think the next quarter or two is going to be really interesting to see, does that behavior continue, and what is the impact does that have on the economy?
Yes. Interesting. And now, of course, the growth of food retailing is less than most. And, we've talked in the podcast about a previous big, fantastic new retailer called Foxtrot in Chicagoland, our headquarters city, that just merged with Dominic's Finer Foods, which had Dom's Fresh Markets. And unfortunately, the whole thing went bankrupt about 2.5 weeks ago. They just didn't open their stores one day, and all the employees were left at loggerheads. So it's really a difficult situation. So food retailing is still slow growth because, it's just the way it is. But within food retailing, certain companies will do better pricing wise. And now, as Chris said, Aldi's doing better than the major, more higher price stores. You wouldn't think Walmart would be higher priced, but kind of looks like they are relative to even an Aldi or a deep discount food store. So very interesting. Chris, back on the technology discussion you had, a lot of folks think, it's great to get a dividend. And so now Google announced a dividend, but for the investors who've been investing in technology stocks like Google and Microsoft and Apple, when a company pays a dividend, that means they're giving you cash. And that means that they don't have a major growth scenario for that cash. Because if they did, they had other acquisitions that they could get more growth for the company and see the stock go up more, they would do that. So the sign that Google's sending to us now is that maybe their growth is starting to slow a little bit. And the way they keep everybody happy is by passing cash to them. Now, another way you can do that is what you mentioned about Apple, the stock buyback, $100 billion of cash. And Apple's got a lot of cash. They've been selling a lot of phones. And they just print cash. It's unbelievable. So they have $100 billion, and they're going to buy back stock. Now, some people, think very negatively about stock buybacks because they think, that's Wall Street taking care of Wall Street and all that, and people want cash. But the reality is, if you look at the capital structure of a company, if you do a stock buyback, that's the same as a dividend, because what it does is it reduces the number of shares outstanding and makes your shares more valuable. So instead of getting the cash in the form of a dividend, by buying back stock, they increase the value of your stock because there's less shares outstanding. So a stock buyback is essentially also a dividend, but they're just not giving you cash right up front. But, Chris, we hear this all the time when people get mad at rich people on Wall Street, the people on TV are always like, no more stock buybacks, stock buybacks are illegal and on and on and on and on. But that's not really the case, is it?
No, no. I mean, I think like you said, Ryan, it's, you know, they can either choose to do a stock buyback or a dividend. Actually, stock buybacks have been more popular because if they buy it back, if you do a dividend, the issue is it's really hard to then remove that dividend. And if you do remove the dividend or decrease it, the company will be severely penalized by investors on Wall Street. So the buyback is usually seen as the better option because, if you decrease buybacks, things like that, the market really doesn't take notice. They just kind of, you get that one-time pop. So, but they are really, like you said, Brian, exactly one and the same. I mean, your shares of Apple are just getting more valuable essentially.
Yeah, right. That's right. Well, good. Well, that's we're coming to the end of our show today. And don't forget, folks, to watch the Leadership Matrix and all the other blog sites on the 4-Star website. You can sign up to get your own direct copy of all the releases that come out of the sites on there. There's the Color Stock site. There's the Optimized Investor site. And then, of course, from the management of the firm, of the Leadership Matrix, and that's published by myself and Brian Principe, who is our marketing director. So be sure to look on there. A lot of interesting subjects on there. Also, Chris, coming up, I'm going to say we're going into interview season. We're going to have Peter Borman from Ridgedale, which is an alternative investment company. We're going to have Chuck Brokaw, who is a 4-Star advisor, but also a money manager who runs the Trend and Defend program. And then we're going to have Sumit Saraf, who is the organizer of a company called Tradeback, which allows investors to invest in international trade and moving money through the international system. It's quite a fascinating story, and that's one of the programs that's in our diversified alternative funds. But we wanted to highlight Tradeback, and it's kind of a very unique structure. So look forward to seeing those interviews. So we're going to have a couple interview episodes. Then we'll be back with some market commentary episodes. Chris, what else do we have for today? Are we done today?
I think that about covers it for today, Brian.
Okay, I think we're done. Thanks everybody for being with us. We look forward to being back with those interview episodes and then also a market commentary episode very soon. We wish you all the best, and we'll leave it here. 4-Star, today's Market Explained for today. Over and out.